Hello and welcome to today's Learn at Lunch webinar. In this webinar, Extension economist Rodney Jones will discuss tips to address financial challenges caused by lower commodity prices. If you have questions, please ask them by using the chat box in the lower right corner. Additional farm management resources may be found on the eFarm Management website. I will paste this address into the chat box shortly. Dr. Jones, I will turn it over to you now.
Well, thank you, Brent, and welcome to the to today's webinar. We've titled this "Managing in Tough Times," and I don't want to take too long here today, but I just want to make a few points that hopefully will be helpful to producers or lenders or others who may be dealing with a little bit of increased financial stress in the ag sector. Just want to note that many producers, we all know producers who are experiencing tougher financial times than they've seen in many, many years or even ever for many of our newer or younger producers. We are certainly in a tougher economic environment. In general, that's more true for our crop-based operations than for our cattle-based operations or those that have a combination of crops and livestock. And of course, as always, the degree to which an individual producer is experiencing some financial stress is going to vary from producer to producer. We do have quite a bit of evidence that the financially stressful situation may be even more pronounced here in the Southern Plains, in Oklahoma and Southern Kansas and Texas and so forth, than it is nationwide, and it is a fact that is being experienced nationwide, but it may be more pronounced here in the Southern Plains just simply due to the fact that we have more variable growing conditions than many other parts of the country, and many of our producers have been dealing not only with the challenging commodity price situation, but also with what I would call back-to-back weather-related production shortfalls over the last few years, and in some cases some natural disasters like fires and those kinds of things, and we all know that. Just a few facts to set the stage here. Overall, U.S. net farm income, net farm profits calculated on an accrual basis, are forecast to drop by about 13% from 2017 levels. And the 2017 levels were already at less than half of the good times, say back in about 2013 when we experienced record net farm income across the United States. So we're down from already low levels, or at least we're forecast to be down from already low levels. Southern Plains, by the way, is forecast to be down 21% from year ago levels in terms of net returns to the average agricultural producer. We're all seeing more frequent examples of cash shortfalls, working capital shortfalls, just a tightness in the ability of our producers to pay their bills. That's certainly the way most of these financially stressful situations pan out. Rising interest rates, albeit slowly, but certainly some noticeable increases in at least operating loan interest, and starting to see some increases in term debt interest rates. Loans may be a little harder to secure for a variety of reasons. A little less solid overall financial position on the part of the borrowers, a little more scrutiny on the part of the lenders. So some producers are finding loans a little bit harder to get. Across the United States, overall farm debt levels are rising at a slow pace, but certainly faster for some producers. operating debt is rising faster than secured debt, term debt, real estate debt, and not at a rapid pace on an overall basis, but certainly at a noticeable pace. So we are seeing some signs of increased financial stress, or maybe slightly worsening financial position on the part of many producers. The question we often get is, is this like the 1980s? Many of us are old enough to kind of remember the 1980s. And if you were around during that time period, remember that time period. It was a very painful time in agriculture. Or if you've studied that era, it was a very rapid decline in commodity prices, along with a very rapid increase in interest rates there in the late 1970s going into the early 1980s, and that resulted in a fairly rapid farm sector economic downturn, combined with asset values declining fairly rapidly. That declining period lasted a fairly short time, followed by what we would now look back on as a relatively rapid, steady recovery in the farm economy. This time around, what we're seeing is an extended period, a multi-year, much slower erosion of net income than we saw in the 1980s, much slower erosion of asset values. In some cases, we've seen very little decline in land values, and in areas where we have seen declines in those core asset values, they haven't been as rapid as we saw in the 1980s. However, the United States has seen this type of a financial downturn in the ag sector before. If you study the 1920s, for example, that period from about 1920 to about 1933, that was an extended 12 to 13 year gradual erosion of net farm income, followed finally by a few year fairly rapid recovery starting in the mid 1930s. So is this more like the 1980s, or is it more like the 1920s? Many people are starting to argue that it's more like the 1920s, and that has some implications for what's going on with agricultural producers, not only from a financial perspective, but this type of a slow and gradual deterioration of the financial picture for many agricultural producers has a different impact on the psychology of the producer and the mental state of the producer than would a more rapid disaster or more rapid decline. And we need to kind of keep that in mind as we work with producers and as we move forward. So, of course, everybody's asking the question, where do we go from here? What do we do about it? And that depends on a lot of factors. How rapidly will interest rates rise? Nobody out there is predicting an interest rate rise like we saw in the early 1980s, but we have seen a few percentage point increase in average operating line of credit interest rates. Interest rates are rising. The current projection is that they'll probably continue to rise a little further, but at a relatively slow pace. But that's certainly a factor to keep an eye on. What about the trade environment? Of course, one of the things that is putting pressure on commodity prices, some commodities more so than others, are the retaliatory tariffs on the part of countries that import our agricultural products, primarily China, which is a very large market. I would like to remind the audience that the tariff situation, the trade situation, is not the only thing that is pulling down commodity prices. We also have very large, very burdensome supplies. So prices might be under a little bit of pressure with or without the current trade situation. But all of us would agree that the current tariff situation is impacting commodity markets. It's just a matter of degree, and we'd like to see that resolved sooner rather than later. It does look like, at least with the Chinese situation, it's going to take a while to resolve the impact of tariffs on agricultural commodities. Another question that's on everyone's mind is what's it going to take to get this crop commodities supply and demand situation back in line a little bit, that would in a situation that would result in some stronger commodity prices. If you'll remember, the crawl out of the 1980s low commodity price situation was helped out with some demand factors, starting to convert a lot of grain to ethanol, particularly as we got into the 1990s. There were some demand shifting things that were going on in that era. If you go clear back to the 1920s, going into the 1930s, we had some demand shifting things that were going on in that era as well. A global conflict, and the United States was called upon in the 1930s to export a lot of ag commodities to other countries who were fighting a war, for example. We don't have anything like that going on. So is there anything on the horizon that could impact the supply or demand situation? Right now, we're not seeing it on the demand side. What it may take is some kind of a global crop shortfall, a cut in the supply, a shift in the supply in the global grain market, in order to stimulate a significant price response. Another question that I've been thinking about a lot lately, in the 1980s, we happened to go through a grain price challenging commodity price situation at a time in the livestock price cycle where livestock prices were still relatively strong, and that helped a lot of producers through that period. In this latest financial downturn, the last few years, cattle prices have been relatively strong. If this is an extended financially stressful time period in agriculture, one question that's on everyone's mind is, will the cattle price cycle low point come along at the same time crop prices are still struggling, which would tend to impact even more of our livestock operations and our diversified operations, which have so far weathered this crunch in a fairly strong fashion. So that's one thing that I'm a little bit concerned about, is will the crop price situation linger long enough that it gets matched up with a drop in livestock prices as well, presenting some even more challenging times. At this point in time, those of us in the ag finance sector are kind of saying, don't count on a rapid commodity price recovery, at least in the grains at this point in time. So the current projection is that this downturn will last a while longer, and we'll likely see some modest interest rate increases as well. So we may need to be prepared to withstand this thing for a few more years. So what can a producer do? Obviously, every producer that we work with, every one of us that are producers, have a different starting point story when we went into this thing. A few years ago, many producers had been in business a long time, had accumulated large equity positions of various forms, had an equipment line that was paid for, maybe some land that was paid for, low debt payment obligations, etc. Obviously, producers in that situation are better able to weather the storm than those of us who may have had to be ramping up our operations over the last 8 to 10 years and incurring some debt, trying to expand a little bit, didn't have the time to build up the equity. So every producer is in a different situation, but we have many producers out there that are struggling to make their debt payment obligations and maintain positive enough margins to make any money. So we fall back on our tried and true tools, monitoring all 5 categories of financial position and performance over time on individual operations. And that means we need to constantly monitor the liquidity situation, the current ratio, for example, the solvency position, the overall net worth and the debt to asset, the debt position of each operation, the term structure of the debts involved in whatever solvency situation we're seeing out there. Monitor measures of profitability, net incomes on individual operations, return on investment, return on equity, um, and how much of that profit is needed to sustain family living withdrawals, is needed to make debt payments, those kinds of things. Financial efficiency, the asset turnover ratio, the interest expense ratio, the depreciation expense ratio. We need to monitor all of those things. And of course, from a lender perspective, we need to be monitoring debt repayment ability measures. Do we have a margin there? In terms of cash ability, cash available to make those debt payments. I often get asked the question, okay, of those 5 categories, which are the most important to monitor? And of course, there is no answer to that. They are all important. However, when we get into a financially stressful situation, we tend to start to keep an eye on the liquidity and the debt serviceability measures. Probably they're going to start to show up as problem areas faster than the other categories, and they're in general the most frequent sources of problems right now. That's not true in every case, but that they're probably the most common sources of at least beginning signs of financial stress. So we're going to monitor liquidity and debt serviceability very carefully and continue to keep an eye on all of the other categories of financial position and performance. The numbers are probably going to tell the story before the operator even realizes that a problem is developing, because the operator is going to start selling down inventories. In other words, they're not going to hold over as much inventory to the next year. They're going to start to cut into those inventories to generate cash. They're going to stop prepaying expenses as aggressively as they have historically. And they're probably not even going to realize that as the cash flow shortfall begins to materialize. But the numbers calculated based on accrual measures are going to start to tell the story before the operator even realizes that a problem is developing. Again, it's the liquidity and repayment indicators that typically start to go south, if you will, first. If we are looking at an operation and looking at an operation over time, our own or as a lender, we're looking at some historical numbers, and we start to see multiple categories of problems developing. We're starting to see a solvency problem develop along with a liquidity problem and a debt repayment ability problem, and we start to look at some efficiency problems. The asset turnover ratio isn't quite what it should be and is deteriorating. Then we've probably got a longer term systemic problem that needs to be addressed, rather than just taking some measures to address short-term financial stress. It's extremely difficult for a business to overcome a situation where they have a solvency problem, a liquidity problem, and a debt repayment problem. If it's just one or two of those categories, it probably is, in fact, a short-term situation, and probably, more likely than not, the problem can be addressed and fixed. Short-term financial problems usually begin to show up because of localized drought. We've had plenty of that in Oklahoma over the last few years. A shortfall in current income that may be caused by low prices. Maybe it's a bad luck situation, excessive machinery repairs this year relative to history just because we had some major breakdown that we had to cover, or some other unforeseen farm expense that is a one-time occurrence. We also see financial stress on a short-term basis sometimes rear its ugly head because of a one-time increase in family living expenses, a medical emergency, for example, or an important event in a family member's life that in fact requires a one-time increase in family living withdrawals that causes a little bit of short-time stress. I'd say globally, in the Southern Plains and across the United States, right now we're probably dealing with low commodity prices being the primary cause, maybe in certain situations mixed with one or two of these other causes. A couple of years of drought or a couple of crops shortfalls because of environmental factors or something combined with the low commodity price situation. So we ask ourselves, is it really a short-term problem? And again, we go back to looking at those historical numbers. If the farm has historically been profitable and efficient, it's just a problem the last year or so, or a couple of years, and you don't see an unwarranted or an unexplainable increase in family living withdrawals, you can probably be pretty comfortable with your assessment that yes, we are looking at a short-term financial stress situation and we need to address it accordingly. So we look at the historical family living withdrawals, we look at production practices compared with history, the current price situation compared with history, and make the best judgment that we can as to whether we're looking at a systemic problem, a long-term problem, or a short-term problem. If we make the determination that it is a short-term, financially stressful situation, then we really have three lines of defense to respond with. We manage cash flows, we manage liabilities, we manage assets. Sometimes those are related responses. Remember, again, the early signs are almost always going to show up as, I just don't have any money in the checking account anymore. Something has happened to my cash flow. So our early signs almost always show up in the cash category. That doesn't mean that cash flow responses are our only line of defense. So we'll talk about just a few specific things that we might do in each of those categories, and these are just common sense things, but we often need to be reminded of what our options are. So managing cash flow strategies might include controlling costs. That's kind of a general statement. Just be the best steward of our production process that we possibly can be by controlling costs as closely as we possibly can. And along with that, don't forget those basic economic principles. We do everything on the margin as a business manager. We're always looking to compare marginal costs with marginal benefits and only pushing that production process as long as the expected marginal benefit exceeds the marginal cost. From a practical perspective, that means that some uses of some inputs that may have been perfectly acceptable and perfectly logical a few years ago when wheat prices were $6.50 a bushel or corn prices were $5 a bushel. Some of those inputs might not pay in today's environment. You can justify the use of additional inputs a lot easier when grain prices are high than when grain prices are low. So sometimes we don't push that production process quite to the extreme in periods of low output prices as we did when prices were a little stronger. Certain inputs we may just not utilize, meaning we may not strive for quite as high of yield levels, and that may be a perfectly logical response to lower commodity prices. We always talk about renegotiating some of the fixed expenses like cash rents, other ongoing costs. I can guarantee you across the United States, there are a lot of efforts to renegotiate things like cash rents in today's environment. How successful is an individual producer in being able to reduce those rental costs by a few dollars? That depends on the situation and may depend on the rapport that has been built up with that particular landlord, for example, over the last 10 or 15 years, and your success in going to that landlord and saying, hey, times have gotten a little tougher. Can we get by with $5 an acre less this year than we've been paying? There's a lot of that going on. And again, it depends on the relationship that you have between that tenant and that landlord. Obviously, reducing capital expenditures, reducing expenses on the big ticket items, at least for a while, holding off buying new or additional equipment, trying to get by with what we have. That's always a frontline defense mechanism. Reducing family living withdrawals, cutting back on how much we need to pull out of this farm or ranch business to live on. That's tough to do, and history has shown that it's tough to reduce those family living withdrawals, but we have evidence that it is going on to some degree. People are tightening their belts. How long we can continue to tighten our belts remains to be seen. Try to find some unused or underutilized facilities or assets that could be used to generate a little bit of income. Do some custom work with the machinery that we have to generate a little bit of extra income. Maybe liquidating or selling some assets that we no longer use or don't use very much. There may be a less expensive way to get the job done in today's environment. And finally, increasing off-farm income, one or more family members doing a few additional things on the side to generate some additional income. And of course, that depends on the geographic location and the opportunities that are out there. In the managing liabilities category, we talk about things like extending loan terms, extending out the terms on some of these loans that we've had that might be expiring in the next year or two. Maybe we only have 2 or 3 payments left, but those payments are pretty large. Negotiate with the lender to see if we can stretch that out an additional year or so to try to lessen the payment, buy time, if you will. Some lenders offer interest-only options on some of their term loans for a year or so. Basically stretch that loan out automatically for another year or so by going a year or two with interest-only payments. I'd caution that we only want to use that if the shortfall is truly projected to be very temporary. It's usually more common on real estate loans than it is on depreciable asset loans, but we've seen some of that going on the last year or so. Again, reducing debt by using off-farm sources or selling those unproductive assets. So some of those strategies that we used in the managed cash flow category also might play into managing liabilities, reducing some of that debt with sources other than farm income, and seeing if there are options out there to refinance at a lower rate using Farm Service Agency guarantees or loans, shuffling some of that debt over to lower interest rate options may be a viable option in some situations. In the manage asset category, liquidate cash or investments. That's usually non-farm items that we might have. Some producers may have some significant off-farm investments that could be liquidated to generate cash. Again, we don't want to do that to the extreme to use up, for example, all of our retirement assets, but if it will help on the margin, it might be a perfectly viable alternative. Again, selling down inventories, we typically hold over quite a bit of inventory to the next year, but we need to generate cash to make some payments this year. We don't hold over quite as much inventory to the following year. And then, of course, selling capital assets, again, those underutilized or not utilized, not efficiently utilized capital assets. Or it might even be some land assets or something like that to get us out of an extreme bind. I would caution that for any of these managing asset strategies, we want to be careful that we're aware of the tax consequences. We may have some capital gains that need to be accounted for and taxes paid on. We may even have some income recapture that would have to be accounted for. Of course, usually we're talking about a situation where the producer is in a fairly low income tax burden year anyway, and so some of this could be done without really triggering a very large tax bite, but we need to be cautious about the magnitude. Again, I want to thank everyone for being on the webinar today or listening later on. I do apologize again for the fact that I don't have any easy answers to the current financial situation that many, not all, but many of our producers are faced with. But it is the situation that it is, and we need to consider all the alternatives that we have at our disposal to help producers work through these more difficult times. Again, I'll stay on for a few more minutes. If you have any questions, be sure and type them into the chat box. Also, I would ask that you please give us some feedback on the webinar today. You can click on the survey instrument web address there on the slideshow or down there in the chat box. We have the webinar survey address. I would again like to remind you that we have a number of farm management resources, tools, publications, and other things available on our eFarm Management website, and that address is listed there in the chat box as well. So thank you very much. Appreciate your attention for the last few minutes.
Thank you, Dr. Jones, and thank you everyone for joining us today. We will announce future webinars on the OSU Farm Management Facebook page.